In this video, I'm going to break down the big 5 banks in Canada for beginner investors. I'm going to compare Canadian bank stocks to US bank stocks, talk about their volatility, their recent performance, as well as some of the risks of investing in Canadian bank stocks right now. So these are the 11 largest banks in North America. You can see that the top 11 banks in North America are made up of 6 that are based in the US and 5 that are based in Canada. Let's start off by looking at the volatility of the US banks compared with the Canadian banks. So when we're talking about volatility, the main indicator to look for in a stock is the beta. So the beta measures the volatility of a stock compared with the overall market. So a beta of 1 represents the volatility of the overall market. A stock with a beta above 1 means that that stock is more volatile than the overall market. A stock with a beta below 1 means that it is less volatile than the overall market. So let's go over the betas of all the top 11 banks in North America. So we have JP Morgan Chase at 1.13, Bank of America at 1.39, Wells Fargo at 1.20, Citigroup at 1.50, Goldman Sachs at 1.42, Morgan Stanley at 1.41, RBC 0.84, TD 0.84, BMO Bank of Montreal at 1.17, Scotiabank at 0.96, and CIBC at 1.10. So what do you notice? All the American banks have a beta of well over 1. In Canada, we have 2 banks, TD and RBC, that have a beta of under 1 at 0.84. So part of my theory as to why the United States has much more volatility when it comes to their bank stocks is because in the United States they have multiple regulators governing multiple banks. Whereas in Canada, we have one regulator governing all of the big banks. In the United States, 2 big banks, JP Morgan and Chase, were allowed to merge. In Canada, 2 major mergers were actually blocked from happening, and I'll get into that a little bit later. So now let's see how the big 5 Canadian banks compare with each other. So based on the graphic that you can see on the screen, you can see that RBC is the largest bank by market cap of $193 billion, followed by TD at 145, BMO at 96, Scotiabank at 86 billion, and CIBC at 64 billion. So what you'll notice if by looking at the net income in 2023 is that RBC and TD made well over $10 billion, and the other 3 banks were much lower, and especially BMO, which struggled at $4.4 billion. 3 out of the 5 Canadian banks have a beta of under 1, meaning they are less volatile than the overall market. Also, you can see that the Canadian banks, which they are known for, provide a very attractive dividend yield to their shareholders, with Scotiabank coming up on top at 6.05%. So now let's look at how the big 5 bank stocks have performed over the last 2 years. So looking at this graph, you can see that TD had a huge spike in net income at the end of 2022. That you can see that RBC has been pretty steady for 2 years and it has come out the highest. You can see that CIBC and Scotia are near the bottom. BMO was doing all right and then it struggled. The main thing to take away, and it reflects in the betas, it reflects in the net income, is that RBC and TD are at the top. They're well diversified, they have exposure to the United States, they have a lot of international banking business. So here's some information you probably didn't know about each of the big 5 banks. So starting with RBC has provided its shareholders an annualized return of 9.3% per year over the last 10 years. As you saw earlier, it is the largest Canadian bank by market cap. It has over $1 trillion in assets under management. In 1998, RBC tried to merge with BMO, but was unsuccessful as it was blocked by the regulator. However, in the year 2000, RBC and BMO joined their merchant payment processor businesses and formed Moneris Solutions, which is Canada's largest payment processor. And you definitely would have tapped your debit or credit card on their Moneris machines when you are making a purchase in a store. And also, personal and commercial banking make up more than half of RBC's income. So moving on to TD. TD is the bank with the largest presence in the United States. In 1998, it tried to merge with CIBC, but was unsuccessful as it was blocked by the regulator. And in this case, it was Prime Minister Paul Martin, who was the Minister of Finance at the time. TD has acquired multiple US financial institutions, including Chrysler Financial Services back in 2011. To Scotiabank, in 2012, it acquired ING Direct Bank of Canada for just over $3 billion, which is now known today as Tangerine Bank, which is why you can use your Tangerine debit card to withdraw from Scotia ATMs. So BMO, Bank of Montreal, is the oldest Canadian bank. It has not missed dividend payouts to shareholders since 1829. Once again, its merger with RBC was blocked by the regulator in 1998. It owns Muneris Solutions jointly with RBC, and it bought AIG Life Insurance Company for $330 million back in 2009. And last but not least, we have CIBC, which in 1961 had 1,200 branches and was the largest Canadian bank at the time. In 1998, CIBC and Loblaws created President's Choice Financial, or PC Financial, and in 2017 the collaboration between CIBC and Loblaws ended, and CIBC took the financial assets of PC Financial and transferred it to create Simply Financial. So now let's go over some of the risks and areas of concern surrounding the Canadian banks. So Rob Wessel, who is the managing partner and co-founder of Hamilton ETFs and also a former top-ranking bank analyst, had some thoughts to share on the state of the Canadian banks right now. He had a great interview on a different channel, which I'll link in the description below, and all of this information comes directly from him. So the big question on everyone's minds is, how will mortgage renewals coming up affect the banks? What he said was, while the fear of delinquencies are a real concern, the higher risk loans for residential homes are all insured. So it's actually CMHC that's on the hook if someone defaults, not the banks. So therefore, the provisions for loan loss or credit losses for residential mortgages in Canada is almost zero for the banks. The other major things that he mentioned was bank revenue growth is correlated with nominal GDP and consumer spending. So it's hard for the bank stocks to go up if the Canadian economy struggles. But as interest rates go down, this will help the banks because it'll boost GDP growth and bank revenues. Now, what about dividends? So will the Canadian banks cut their dividends in such an uncertain time? So Rob Wessel said that the last time they did, it was National Bank, which was in 1992, and it was due to a severe credit cycle. He said that there is a much higher chance that they will raise money through equity than cut the dividend. So me personally, I'm starting a position in TD and RBC, but what are your thoughts on the Canadian banks? Do you already have a position? Are you buying shares? Let me know in the comments below. If you got value from this video, make sure to drop a like and subscribe for more investing content, and I'll see you in the next one.